Come here over here. People's Home Equity, Mortgage Lending, Tennessee, Virginia. We're going to talk about credit reports today. Credit scores. Are you excited about credit scores? Woo! Yay! Yeah. Credit scores. Everybody needs a credit score. Woo! Dave Ramsey says you don't need a credit score. Dave doesn't need a credit score. He's got all kinds of money. Right? So everybody else in the world needs a credit score. Right? Actually, I had a client come to me the other day that didn't have a credit score, and he was following Dave's plan, and I said, you really need a credit score. He said, Dave says I don't need a credit score. So if you're going to get a mortgage, you're going to have to get a credit score. So, anyway, so he listened.
Go borrow your money from Dave Ramsey?
Yeah, go borrow from Dave. And he won't lend to you because he doesn't lend, or he doesn't believe in that. So what I wanted to ask is, you know, instead of just talking, I was going to get some what you guys questions that you had about credit. So Joey, you're actually looking at me. So what do you think about credit? What question do you have? I want to make sure you cover it. Joey is number one.
Okay, I'm skipping Joey.
Okay.
Yeah. Okay. Yeah.
Credit when you pay off a mortgage.
Credit.
Is it tank?
Credit when you pay off a mortgage. Okay. Pay off. You're not going to be able to read this, by the way. Mortgage. Tank. Okay. Question mark. All right. What other questions? I'm going to cover.
Should I pay my credit card payments or pay it off in full?
Oh, that's a good one.
Credit card payments.
But you should pay it off in full.
Or in full.
Because you're going to pay
Okay.
for it not.
This is the fine marker. So, how about you, Matt? We got a question? Something about credit?
Is there anything that I should I just call and pay something off if I have something that's in collection, or is there something else I should do?
And
Okay.
pay a $25
Collection.
fee for Joey's, because she marked
Okay.
age for the
Got it.
trainer.
If I have no credit and
So he's got a new trick one for him. I printed it, but it won't let me call.
like no credit cards, anything like that, what can I do to start
Okay, so
credit?
you don't have
Like
to
what
worry
are
about
ways
it.
to be able
No,
to
we already included, that was included in.
create
That's
some
right.
sort of
That's what
Perfect.
I mailed.
Great. Okay.
What she's talking about.
So, we got 1, 2, 3, 4. Yeah, 1, 2, 3, 4. How about you, Ariel? Credit question?
Let's see. Thanks.
Or anything that, so instead of me just starting talking, my idea was, well, if you had certain things that you were concerned about, or, you know, there was kind of a hot topic, then I can write those down, and I can focus on those, instead of you just kind of rambling on about, you know, whatever. So, how about you?
Alexa.
What?
Alexa.
I missed it.
Yeah. What were they, when you had, when you call 911? Like, this is the first thing you do when you're going to give
What's the
CPR?
number?
You
Oh,
have to
yeah.
point at the person and say, you, call 911. So you, what do you think? We're talking about credit scores, credit reports, and things like that. You can't read that. This is for me. Yeah, you can't read any of it. Don't expect to be able to read it. But I'm curious about what something about credit that you've always wondered about, or issues, you know, with your, you know, you got something going on with a client, or
what causes like drastic changes in my credit? So if I was to miss like one payment, how badly is it going to hurt?
okay. Okay. Drastic changes in credit. Okay. Anything else?
What is Experian Boost?
What is Experian Boost?
Is it a real thing? Because somebody had asked me that before, and I
Okay.
didn't know the answer.
Experian Boost. What is it? Okay. Anything else?
So the big no-nos, how long does it take to forgive those? Like going into foreclosure, missing a payment, or bankruptcy?
Yeah, I've actually had like charge-offs before that were really hindering my credit, and then how long does it take for them to fall off?
Yeah.
Okay. All right. Okay. All right. Anything else? Is that enough? All right, cool. So, credit scores. Why do we even have credit scores? Well, there was, back in the day, there wasn't anything, there was no such thing as a credit reports or credit scores, and they were done like Fair Isaac Company, FICO, that's how that got its name, probably in New York City or something like that. They would go around and they would actually talk to individuals. They would they would create their own credit system, so that, you know, if you're going to lend to somebody and you're you're in a community, how do you know if you don't, you know, start out when you're in a small community, you kind of know that, you know, Fred's a deadbeat, so you don't loan Fred, right? But the bigger the community gets, you don't know, you know, you just don't know Fred, right? He could walk in and, somebody actually took a shower, shaved, and came in, and he looked good. But not shaving's a bad thing or a good thing. But so you had to come up with a way. So so back in the day, there was, I think, Fair Isaac's company, and they had a certain amount of data about people, and then through the years, it just began to grow and become a big part of, lending what we see today. And it's much more sophisticated even than it was 20, 30 years ago. And it is integral to the mortgage industry. So whenever you may remember when you took your real estate class, we talked about in mortgages automated underwriting. I don't know if you probably don't, you just blocked that out of your mind. But there's a part of the process that we do underwriting on somebody, looking at their cash, their credit, their income. But there's a part of that where we run them through an algorithm. It's called an automated underwriting, desktop underwriter or DU or LP. You don't need to remember all that. But there's an integral part of that where the credit report has to feed into that. And so that credit report, it becomes the Bible. If it's not accurate, then it's going to give you faulty information, because the automated underwriting system is going to say thumbs up or thumbs down, and a significant portion of its ability to understand the credit worthiness of a borrower is going to be because of that credit report. So regardless of whether the information is true on the credit report, it is, you are guilty until proven innocent. If it's on there, it's yours. You've got to prove to get it off. Even if you prove to me that it's not yours, you have to prove to the credit bureaus so they can take it off, so that we can use that and now go forward. Because if it's there, the underwriter says, I'm not going to judge whether that's true or not true, right? You have to convince them. Once you convince them, then I believe whatever they tell me. So it's pretty important. And I was only half joking about, you've got to have a credit score. Now, there may be some local bank that if you're putting 50% down and you don't have a credit score, they might be able to work with you, but us normal human beings, that's probably not going to work. So let me talk about this. So there are 3 bureaus, TransUnion, Equifax, and Experian. So in the mortgage business, what we do is we're going to pull all 3 bureaus on Joey. And Joey's, sometimes a creditor might report, like people say, why are they different? Well, it depends on what's reporting. So many times collection companies anyway, picking on Joey. So Joey's got a collection, and one of those collection agencies, because I believe that it costs money for them to report to the bureaus. So maybe what happens is that, we're not going to report to all 3 of them because it costs money, maybe pennies a month or dollars a month or whatever. So they'll report to one bureau. So you may have, 2 scores that are good and 1 score that's really off. Or you may have 2 that are, they may not be the same. So you have to look at the credit report to find out who's reporting, because what we do as a mortgage lender is we throw away the highest score and throw away the lowest score and use the middle. We don't average them. We just assume that the middle score is, that's just what mortgage people do. So, but there are the 3 different bureaus, we needed some sort of a standardization of credit history. You can always get the data for your credit reports from, I think it's annualcreditreport.com. I think the federal government says you have to be able to get a copy of your credit report, but there's no score. You can see the data, but there's no score that you can pay money to get a score. But so that's, the data is where everything is driven off of that. So when we're talking about scores, what makes up the score? Well, one of the things I was going to show here, I don't know that these markers are kind of light. So if we're looking at the pie chart of we've got, it's about a third. About a third of the score is going to be set up 1/3, 1/3, and then this third is broken down in a couple different ways. But a third of your score is a result of credit utilization. So if you've got a credit card with $1,000 balance and you have $1,000 on it, it has a $1,000 limit and you have $1,000 on it, then your utilization rate is at 100%. So that's going to drive your score down. So when I'm talking to people about, the low-hanging fruit, when I'm talking to somebody about the credit scores, I immediately go to what are their balances. So hopefully they've got 3 credit cards and they got about $300 limits and they've maxed them all out. So if we pay those down and people into debt every day, mortgages. So I can sleep at night because people have to have a place to live, and mortgages, most people can't do that, can't pay cash for the houses. But I've been on the other side of bad credit card debt, and so I don't want anybody to give me credit card debt, right? But use it as a tool. So you've got to have, in order to get a mortgage, except for the way outliers, you're gonna have to have a credit score. So we look at it from the standpoint of how do we manage that? So about a third of the score is driven off of your utilization rate. Another third is driven off of have you paid as agreed? So when I look at a credit report, I see these little black number ones, and they're all stacked side by side. That tells me, yes, he paid as, or she paid as agreed. So what does that mean? Well, if you agreed to not pay anything because you're in forbearance, you're still paying as agreed. If you agreed to pay $25 a month as a minimum payment, and you paid $25 a month, then you paid as agreed. If you said I would pay $25 a month and you forgot, then that's not paying as agreed. So that's gonna hit you and drive your score down. The more recent that incident is to the time we pull the credit is gonna have the most impact. So if you forgot last month, then that's gonna drive the score down more. If it's been 6 months and then it's been a year, the farther you go away from that event, it's gonna have less of an impact on your credit score. It seems kind of obvious, but we're looking for things that are financial stressors. So, if you're looking at your utilization rate, well, if you have $1,000 limit and you've got 1,050 on it because the credit card company will allow you to do that, it really drives your score down. And from an outsider looking in, you appear to be financially stressed because you've maxed your cards out. I tell people, okay, if you've got a $1,000 limit and you don't have anything on it, it's like, hey, look at me, how responsible I am. I don't have any. I have all this credit over here, but I don't need it, and that's going to make my score go up. So, so we're going to be looking at, the big pieces of the pie are, what are my balances and what's my utilization rate, and then the other part is what is my did I pay as agreed? So I'm looking at this one where we're talking about the utilization rate is the easier one to fix if you've got any cash to work with. This one you can only fix usually with time. Right? Pay your stuff on time, don't be late, and move forward. And so we can predict sometimes how long. I can run a simulation through one of the credit bureaus and see, well, in 6 months it should be here, and whatever it would be. But generally, when I'm talking to somebody about fixing the credit, I'm in the quadrant, or I'm in the third we're talking about how can we fix your utilization rate. Let me think. And then the other thirds is broken down into, so you get payment history, or did you pay as agreed? You've got the amount owed, or your utilization rate. And then the other two are like credit types. So you're going to have a mix of installment and revolving. So then you've got new credit. Have you had your credit pulled recently? What kind of how recent? Because it's like the more active you've been, it's like, well, there's something going on, and maybe that's an indicator of financial stress because you've tried to get, you've signed up for 6 of those credit cards that you got in the mail, those types of things. And then
Does even checking it affect that?
if you check it yourself, then there's a way you can do a soft pull, and I'll talk about that in a little bit. But whenever I pull it, or when, what I'll see is some of the stressors will be, well, how many times have you had your credit pulled, and by whom, and how often, and things like that. So, when you're one of the big questions I get a lot of time is, I don't want to have you pull my credit because it's gonna knock the credit score down. Well, if the way the bureaus look at it is that they give you a certain period of time. I think it's like a 2-week window that if I pull your credit for a mortgage, and then somebody else pulls your credit for the mortgage, the first hit is it's not going to have a negative effect because once you pull, they consider that 2-week window one pull. Now, if we pull it this month and then you try to pull it next month and then you pull it next month, and I see that. I don't really understand why loan officers do that, but it's like they think there's a miracle going to happen, so they just kind of maybe something. So we're going to pull it again this month, and well, that didn't work. So I can see the scores going down every month, I'm like, stop it, just stop it. You know, let's let it heal. Because what happens is like you're pulling the plant up by the roots, it's not growing up, so we stick it back in the ground, and it's stunted, and it gets worse every month when you pull it out. So my advice is to use a service called myfico.com. And myfico.com it's a paid service, but you can pull your credit, you can pull your mortgage scores, you can pull your credit card scores, your insurance scores, all those different things. Now it costs you, the one I tell people to get is about $40 a month. But when you do that, it's a soft pull, and you don't have, it doesn't affect, it's you pulling your own credit, so it's not negative, it doesn't even report to the bureaus. But you do get to see the real numbers. So what I'll tell somebody is I'll pull their credit and I'll see a client is marginal, they need some things to work on, and I'll give them advice on what to do, and then I'll tell them, here's the steps. I've told you what to do, so I want you to set up like Credit Karma, right? Don't trust Credit Karma, by the way. So the scores are bogus. They're just different. They use a different model. So the ones you have to use, if you're gonna look them up, you've got to use FICO scores 5, 4, and 2. Those are the 3 scores that you got to look for. If you're in myfico.com, you can pull those scores. So when Matt, you pull your scores in myfico.com and you get those 5, 4, and 2, you say, hey, my scores are A, B, and C. I know that if I pull them on that same day, I'm going to see those exact scores. There's no guessing. So that's the beautiful thing. It's like now we know what we have. I don't care to pull somebody's credit. It only costs me $20 to pull somebody's credit, but it doesn't help them. So what I tell them is, okay, we have a plan. I want you to pay this down. I want you to pay this off. I want to do whatever the advice would be. I want you to set up Credit Karma, and I want you to watch and see the trend that Credit Karma tells you, right? Because I mean, if you've got enough money, then go ahead and set up MyFICO, and you can get a report every month. But the first thing, a lot of folks that are in trouble, they don't have a lot of extra money. So I'll say, monitor first with Credit Karma. Then once you see that you think it might be near where you need to be, then pay for MyFICO. Look at those scores. Sometimes they still don't know what it is, so I'll say, well, you know, you've already given me everything else about your life. Give me your password so I can get into MyFICO. I'll look at it with you, or we'll look at it, share the screen, and we'll look at it together. And I can tell from there, well, this is where we're at, this is where we need to be. Okay, so we just keep monitoring, and so once we get it where it needs to be, then I can pull it, and I know what I'm gonna get. You know, where they say attorneys never ask somebody on the stand a question you don't know the answer to. So I want to know the answer before I pull the credit. Now sometimes people will say, I think a miracle happened, you know, I'm like, pull it. Okay, you know, and I'm like, oh, it wasn't where I wanted. You didn't do what I told you. So, you know, when I'm talking to specifically talking about mortgages, when, you know, it's a common thing, I pull their credit, you know, let's talk about the people I talked to yesterday. The husband and wife, his scores were good, one of her scores was 500, one was 560, one was 565, right? I can't really do anything with that. So I'm talking to her, and I realize that she's selling a house. She's gonna have like 50 grand, because I'm about ready to say, we're not gonna be able to help you, we'll call us later. Well, she's selling a house, she's gonna have about 60 grand in her pocket. Okay, now I got something to work with. They have jobs, which is good, and they've got cash to work with. Their credit score good. So I can tell by looking at hers that there's just a lot of high balances on credit cards. Okay, so like I've got something to work with here. So I've got this afternoon, I've got to go through and do a strategy for her to say, well, if you pay this and this and this and this off, or pay these down, you know, at this point, then this may happen and that may happen. And that's the hardest one for me to do, because I've got to really, you know, they're counting on me to give them the good advice. And, you know, most folks, I think, they'll just say, you know, come back when your score's higher. But to be able to go through those with them, give them the advice, and then, you know, give them the steps. Pay these things off. You're going to have enough. Instead of putting 20% down on the house, let's put the money down on the credit cards, pay these off. She's got some medical collections that she tells me she can actually get removed. Now, usually what happens, let me cover something. I was going to say payoff collections. One of the questions was call and payoff collections. So ideally, if you're going to call and pay off a collection, the first thing you need to do is look and see how long has it been since that collection has reported by the Bureau. So if it's been 2 years and they haven't reported anything, let that sleeping dog lie. Just let it go. Right now, if it's $20,000 and it's a repo on a car, that's gonna be something that you're gonna have to address eventually. So, but if you've got collections,
Hey guys, how's
it
it
could
going?
be medical, it could be,
Appreciate it, yeah. Yeah, I'm good.
it could be any number of things. But if it hasn't reported in a while, then just let it lie. Now, if it's reporting every month, and you can see that it's $300 and it's a medical or a non-medical, whatever it is, then we're gonna, it's not gonna go away. But people think, well, once I pay it, then everything's gonna be all right. Well, the problem is that when you pay it off, it stops the bleeding, but it doesn't fix it immediately. It allows the healing to start, so you've got to have some time from there. Now, there's a rare occasion where you can get from the creditor something called a deletion letter that just says it never happened in the first place. So if you, there are rare occasions that you can get that, but if you can do that, then once it's actually been deleted from your account, not just showing that it's been paid off now, then you can actually, it'll have a major impact on the credit score. Okay.
What time is it?
So
Are those more common with one type of collection than another?
usually it's somebody that's really recent, and let's say that you didn't realize that there was a collection, a medical office sent it for collection. You call the medical office and say, look, I don't think I ever got the bill. It was, a month, 2 months ago. I'm willing to pay it, and what they'll do is they'll tell like many times they'll just instantly turn over to a collection agency. So what they'll do is they'll say, go to the collection agency and say, this has been paid in full, just retract that whole thing. And so that works. I've had one that was a local utility. I don't know if it was Bright Ridge or something like that, but they had something like, they paid Bright Ridge full amount, and I tell them to if you can get that, if you think you can get that, that's great, but you need to get it in writing that you're going to get that, because it's collection agencies are notorious for telling you anything. So I also tell people when they're calling to try to get something settled, I'll say, whatever you do, don't tell them, I'm trying to get a mortgage, I need to get this thing settled. Like, ding, 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 you got a big sucker, sign on your head that says, okay, not only do you have to pay this off in full, but there's gonna be additional fees. So if you said, and I've done this, a sister-in-law of mine, she got into some credit issues, and she had a little bit of money from a little tiny settlement. And so I just called the creditors. I said, look, I'm the brother-in-law. She didn't have any money. We got a little bit here. This is a $600 bill. I got $150. If you'll take it, great. If not, there's somebody in line after you. Oh, hold on, sir. I'll take that. So generally, the collection agency will buy it for pennies on the dollar. I mean, they might buy a $1,000 debt for literally $100. So if you but you can't be desperate, right? That's the thing. You can't push it. You just got to say, I got a little bit extra this month. Okay. If you don't want it, that's fine. I'll call you back next month if I've got any extra. So you can't be desperate, and you got to be willing to. That's the reason you want somebody that's going to get pre-qualified. Get them early so that they can have some time. They're not in a rush, because you can't rush that kind of thing. I mean, you can, but you end up painful price. So, but again, when it comes to collections, you're going to want to. Just because it's paid off doesn't mean, oh, it's gone now. It's still there. It may get you a small bump, but the longer again, all that does is stop the bleeding, and so over the next 6 months or a year, it allows the healing to start. If you can negotiate something else, where it's a deletion letter, that's one thing. Let's see. What was it? I've never heard of Experian Boost. So so I don't know.
Commercials.
Yeah.
Somebody asked me, and I'm
Yeah.
like, I don't know.
John Cena is the spokesperson.
Oh,
He
Must
says,
be.
Experian.
Is that what it is?
Yeah,
Okay.
'cause it's him and a cow.
I don't know why. It's a
Interesting.
confusing commercial.
Yeah, okay.
Maybe you can milk them for what they got.
So I don't really know to answer that question. The only thing that I can imagine is that it's a formal way to manipulate the score that would be similar to what I would do. For example, somebody comes in and they've got installment loans, but they don't have any revolving credit, and you know, it's just kind of sketchy. You know, then what I tell them, let's get a credit card, get a $300 card. You know, with you know, if you can get one that doesn't have, you don't have to have a secured card, or if you do, just get a $300 card, put Netflix on it, pay it off every month. And I've seen people get 50 points in score, you know, immediately from doing something like that. You talked about if you don't have any score, that's what I tell people: get a credit card with a, you know, don't max it out. So I'm not telling you to get a $300 limit and then go put $300 on it. I want you to keep the balance down very, very low, under 10%. Buy a cheeseburger or a tank full of gas or Netflix once a month, and then just pay it off. And it's like saying, look at me, how responsible I am. I have credit, but I don't really use it, and I'm paying everything off. So what happens is, you know, you could be a third of the pie that if all you have is installment loans, you don't have any credit utilization rate because it's all in installment. So really, the best thing to do is have a little mix of installment and credit card. You know, when somebody's, let's see, foreclosure, bankruptcy, you know, what happens with a bankruptcy, you know, to share some of my story, you know, I went through 10.5 years ago, I went through bankruptcy and foreclosure, I lost everything. So what happens is, the good news is, if there is any good news out of that, is that you start all over, right? So everything stops unless you reaffirm. And you can reaffirm a car or different things like that, but everything stops, and you have no credit. In about 6 months, your scores go to zero, generally speaking. Then what happens immediately after, you know, the credit card companies find out that once you've been through bankruptcy, you start getting all these offers. I just came through bankruptcy. Why do I get all these offers? Well, you can only file for bankruptcy once every 7 years. So they figured, you're a pretty good bet for the next 7 years. So I'm going to give you a $300 limit or a $200 limit, and I'm going to get you started. And you can begin to build your credit. Because if you go through a bankruptcy or foreclosure and you don't do anything to reestablish credit, then the good news is, you know, we talked about mortgages before, you're going to need, for like an FHA loan, you need, I think it's 2 years out of a bankruptcy or foreclosure. VA is about 2 years. Conventional is going to be 5 years. There's different times that you have to wait. But even with those, that waiting period, you have to reestablish credit. So my advice is always get that credit card. I mean, you're going through a bankruptcy, you know, different reasons people go through a bankruptcy. But if you can't handle it, don't get it. But if you have the discipline to get that card and then don't max it out, just use it a little bit, and then maybe get a little installment. Do not go to payday lending. Do not go to, I mean, there's a ton of places like World Finance, any of those finance companies. People will get those to boost their credit, and it does not help. If the term is less than 12 months, then it's considered high risk finance company, and so it doesn't help your credit. So what will happen if you look at the terms on the World Finance is like they'll be like a balloon in 11 months, and they'll roll you over into another one, roll you over into another one, and so it just keeps you on that. You know, it's a cycle that it doesn't help your credit scores, and plus you're paying a lot of interest. Okay. So,
one thing to talk about,
yeah.
the secured credit cards, there's some, just if somebody gets a credit card, they need to make sure that it reports to all their bureaus.
That's right, yeah. There was a time when, who was it, Clinchfield Federal Credit Union in Arrowood, they would only, as a credit, they would only report to one bureau. So I'd have people that, what's that? Is that right? Okay. So what would happen is they would only report to one bureau. So if we throw away the high one and the low one, the middle one's zero. Doesn't help us. So you got to make sure that they're reporting to all three bureaus. So you know, those are, and this is our credit card lady. She was doing credit cards before she came to work with me. So I don't know about Experian Boost. We talked about foreclosure, bankruptcy, charge-offs. Okay, charge-offs. They're looked at differently. Charge-off. It's complicated. Like Dustin's relationships. They're complicated. You're a good sport. I'm glad I can pick on you. Just stay on the other side of the wall and you'll be good. Uh-oh, it's coming around. So
Get more coffee.
it really depends on, like, if it's a charge off, generally speaking, if it's been charged off, we don't have to worry about it. But there are times, well, let me talk about the different negative things. So from a mortgage standpoint, if you have medical collections, your credit score is already taken a hit. The thing that, the industry has decided that there's so much medical collection out there, if you've already taken a hit with your score, we don't care about it. You can have $100,000 worth of medical collections, and we don't care, right? You've already, it's already driven your score down, and you're gonna take that hit. But if if you have other debt that you've got a balance that's hanging out there that they're trying to collect, and many times if it's over $2,000 or $3,000, then we have to look at it. Like VA treats it differently than FHA and different ones, but we have to look at it and say, well, we have to either have it paid in full, or we have to have a payment plan, things like that. So if you got somebody that's got, the one the most recent to me is, usually it's the other way around, but a young guy co-signed for a car with his dad, and his dad didn't pay the bill and let the car go back. So there's like a $12,000 balance left. It was a repo. It shows that it's charged off, but there's a $12,000 balance. And so we can't get around that. Somebody's gonna have to pay something on the car. So he was gonna do a VA loan. We had to use 5% of the outstanding balance, 5% a year, I think is what it is. Anyway, we had to come up with a phantom payment. And so that wasn't good. Or he could settle, but that's a lot of money to settle, and so it really just depends. There's a lot of things that go in. It's not just score, but it's also, what if those balances are out there? How do we look at those, and how can we make that work? And sometimes it's like there's just a hard wall there. Go talk to dad, maybe get him to, go get a loan, pay it off. There's a lot of stuff like that. Let's see. Charge-offs, no credit. What do we do to start? That's going to be basically getting, if you can, get a credit card, and if you can, get a small installment loan, it would be best. And should you pay your balance in full or pay payments? The key is, remember looking at a third of it is did you pay as agreed. So whatever you do, don't pay anything less than the minimum, right? What I tell people is to set it up to where there's an auto pay for the minimum on all your cards. That way, if you forget, it's going to auto pay at least $25, so you're not going to be late. Then it's like, oh, I forgot to make the payment. Well, I can make a bigger payment. But whatever you do, make the smaller payment.
What do you do with cards that are paid in full?
You just let them rest. Occasionally use one to buy a cheeseburger just to keep it alive.
Okay.
Don't close them.
Right.
So the older the card is, the more weight it has. So it's going to look the length of time you've had something. So, years ago I was bad at that. I was like, I don't want anything to do with it. I'm just close that account.
Yeah.
And it was a card that I had for 15 years, and it would have had. You don't want to be a slave to a credit score, but it's a game. So keep that old card. If you're going to close anything, close something you opened a year ago. Just use it every once in a while to keep it alive. That's what I would advise. So.
You're talking about making the minimum payment, Tim, but what about like when you get that bill and it says if you only make the minimum payment, you'll pay this much back in interest in the next 5 years, but if you make this amount,
right.
If you make a payment for this amount, you only pay this much interest,
right. Well, it's obviously, from a financial standpoint, it's kind of two different questions. Right, so we've got the credit score. We're just trying to manipulate the credit score. Is all and why would you have a credit card with 21% interest and have any balance on it all? So, I make fun of Dave Ramsey, but I'm all about. I had a client the other day that I threatened to buy her a Dave Ramsey book for a closing gift. She was, she had
needs help.
She made $250,000 a year, maxed out her credit cards. Didn't pay stuff on time. She had had a 568 credit score, and she had all kinds of money, right? Plenty of cash flow. She just forgot or whatever it is. And I'm like, And the funny thing is that I helped her, that's the second house I helped her buy. First one I had to help get her credit score up. Second one I didn't have time to get her credit score up. And so, I mean, the interesting thing was that I didn't think I could do an FHA loan with a 563 credit score. But she had 10% down, low debt to income ratio, all those different things. So she had a bit of a perfect storm. But, so my point is that, I joke about Dave Ramsey, but get out of debt, get out of debt, get out of debt. So I agree with you. The best thing to do is to pay it off and not even have it in the first place. But if you're going to play the credit game where I'm going to make sure I've got the best score, it's going to be, last thing you want to do is accidentally forget to pay a $25 bill.
Yeah.
So setting, it just happens. It's like I had good intentions, or I changed bank accounts, it was already set up, and, or whatever. So having that set up so where you're absolutely making the minimum, but then pay the whole thing off. I have credit cards that I run the business through, and my goal is to pay them off every month. But there's so much going through that I never know when it never has a real zero balance. It's just kind of like there's money going in, money going out, money going in, and but I still have it set up on the minimum payment, with Capital One, whatever it is. So let's see, when you pay off the mortgage, does it tank? I don't think that is. I've not seen that tank. It might have a small effect, but as far as a significant number drop or anything like that, no. Now there are. What happens a lot of times is you all get to, you hear a story, but you don't have the facts that back it up. So I've got the truth serum when somebody says, oh, I got a great score, it's great, really put your credit. Like, well, it's not maybe as great as I said, because they know that I'm gonna see it. Like, I got the x-rays, I got the blood work, you're a drug head, it says it right here. I can just, so when I pull the credit, I can tell. And what I'll do with a client is I'll go through the different. I say, is this yours? Is this yours? Does this seem about right? Yeah. Because many times there are inaccuracies, especially guys that, I'm a junior. And that's my dad's stuff. Okay, well we got to get that off there because dad's deadbeat. He's not paying his bills, so we got to get it off of you, so that we can, or vice versa. My son.
Somebody had him. He was like that. He got the same first name as his dad. So when he was 18, he got all these he got something in the mail for a credit card, but they assumed it was his dad. So when his dad went to go apply for something, like, well, you have an outstanding credit card of like $4 grand.
Yeah. He's
like, oh, no. Couldn't find out. Adam had just thought it was just free money and was just going all willy-nilly with it.
Yeah. So I don't know that you're going to have some effect on the mortgage, but it's not going to be significant. Should you pay off in payments or pay in full? I think we covered that. What causes drastic changes in credit? Really, it's when you don't pay something on time, or you've had the big ones. If something goes to collections, those are the drastic changes. But you can have. We forgot to make a mortgage payment 3 years ago, and everything else is clean on the. So 10 years out of the bankruptcy. So I've got like a 735 credit score. Right. So finally, after 7 years, it's not supposed to affect your credit, but after 10 years, it's supposed to fall off and not even show. So nothing's showing, but 4 years ago we were on vacation. We were late on a mortgage payment of all things. So the only thing keeping me from going any higher, because my utilization rates are low, everything else is good, is there's this one thing, and the farther it gets away, once it's 6 years and then it's 7 years and then it's 8 years, it's like, okay, that won't be an effect at all on my credit score. So
say you pay your mortgage, say it's due on the 1st, and you pay it like the 4th or something. They say like if there's like a grace period of like it's late by the whatever, does it count as late if it's not paid on the 1st when it's due, or by the time they charge that?
So mortgages are always due on the 1st, late on the 15th. So you've got a full 2 weeks to get it in. Now, what the bureaus will report is a full 30-day late. So you could be on day 17, right? Your check arrives on the 17th. You'll get charged the fee for being late, 4 to 5% of the monthly payment. but it won't be 30 days late, so it won't show up on your credit report. Okay, so there's this grace period, and then there's a little bit more of a grace period, and then once you're full 30 days late, they'll report to the bureau. So there's a lot of grace period. I mean, it's better than, I rented for a while after we were coming through our stuff, and we were 1 day late, and we got the letter. I'm like, hey, I know the guy, the property manager. He said, everybody gets a letter. Right, I'm 1 day late. Oh, my goodness.
Who is your property manager? Tim Stone.
And as a renter, I was like, but if I ever needed somebody to be a property manager, I'm like, okay. He said, I'll kick my own grandmother out, right? Because that's what I'm being paid to do. I'm like,
Just do it and I'll get my
So,
stuff together.
but if you're renting, you don't have the 2-week grace period. So it's so there's a lot of obviously there are a lot of reasons to buy. I don't know that I thought it was a little bit jumbled here, but let's see. Yeah, don't trust Credit Karma or Credit Sesame or Capital One. It's a FICO versus a FACO. All right. If you want your real scores,
What about like the ones that, like the credit card companies, like on the app, like a Discover or Capital One?
Yeah, I was told one time that the credit bureaus spent a lot of money developing a new credit reporting number system algorithm. Spent millions or billions or whatever they did, and it didn't take off by the creditors, so they turned it into Credit Karma.
Okay.
So that was from, actually, there's a guy that, so I feel like that I take care of the low-hanging fruit with credit, and if we need something above that, I've got my credit guy. So his name is Mike Garcia with Credit Security Group, and I send probably 3 or 4 people a week to him. Now, he costs money, but he would be the guy that he's gonna look at their situation and say, if you do these 3 things, ignore the other stuff, in 6 months, you're gonna be where you need to be. And so there's some things I feel comfortable giving advice on, other things I'm like, this is above my pay grade, you're gonna need to talk to this guy. So let's say he costs $150 for a consultation. I use it as a litmus test too. If the borrower says $150, I can't afford that. Like, you wanna buy a house, you don't have $150, I'm good, right? So if you're not motivated to spend $150 to get your credit fixed, I shouldn't be more motivated than you are to get you a house. So that tells me something about you. Let's see, we talked about the mortgage scores. Pay the money if you want. In general, the higher your score, the less you're going to pay for credit, and the more options you have. And it's kind of obvious, if you're the lower your score, the less options you have, the more you pay. So if you got a 580 score and you're not a military veteran, you're going to have an FHA loan, and you're going to pay a pretty penny for that because the rate's going to be higher, or the cost for the rate's going to be higher. There are times, 100% financing starts really at a 640. I've got one program that technically can go down to 620, but if you don't have any money and you're trying to do 100% financing, and this particular program costs you an extra 1.5, I mean, the first-time home buyers are just squeezed out of this market right now. I mean, it's rare. It's like, it used to be that we can negotiate for a seller to pay closing costs, but we can finish up. I don't know if there's anything else. So, it's been a little bit.
Well, I just emailed you back. I just got. I need to send that check on to